Okay. So good morning, everybody. Thank you for taking some time out of your day to drop in and catch up on some of the things that we're seeing in the markets and some of the things that we're doing within portfolios. I want to spend a few minutes just sort of giving an overview on what's going on with the U.S. economy, give a quick recap on where markets have been in the first half of the year, touch on the investment strategy, which we're sort of at a crossroads today. Got some really interesting data out this morning that's kind of creating some pivot points. I'm going to spend a few minutes touching on some market technicals, which kind of follow into that pivot that we're seeing. Highlight some of the upcoming macro events. The election certainly is one of those. And then we've got some time for some questions towards the end. Again, if you have any questions, feel free to use the chat, drop them in there. We'll be monitoring that throughout, and we'll address those. All right. So when we think about the economy, it's really about two key variables, one being inflation, the second being the jobs, labor market, and then really how the Federal Reserve interprets that data. Because when we think about the markets and the economy, two very different things, they intersect with the Fed. The Fed's monetary policy, how they interpret the economic data, how they adjust interest rates according to that data, that has an impact on the markets. So we need to be aware of where the economy is. We need to be thinking about what's going on with the economy because there is going to be some intersection within the markets, and it's really where the Fed sort of creates that intersection for us. So we're just going to focus on these 2 points. We could spend 2 hours talking about some of the relevant economic data, but I kind of boil it down to these two factors. And one of them, we got an update on this morning. On this chart, just to put this in perspective, we're looking at the two primary components, or the two primary measures of consumer inflation. The blue line is the consumer price index, which we got out this morning. The red line is the personal consumption expenditure, the PCE price index. That's important because that's the Fed's preferred inflation measure. That's the one that they pay most attention to. What was sort of three key things that we can see from this chart here. The first is over the last 2 years, inflation in both measures had come down dramatically. When we look at kind of where inflation was back in spring of 2022, up here around 9% for the CPI and 7% for the PCE, those were extraordinarily high levels. And now we're down at a level, the PCE is about 2.6% year over year. The CPI that we got this morning, the headline is basically 3% year over year. So we've seen a rapid disinflation over the last couple of years, and a big part of that is certainly because of the Fed raising interest rates aggressively and then holding interest rates for the better part of the last year. So that's one big takeaway. Inflation has really stepped down over the last 2 years. The second is this purple line, and this is looking at the difference between those two measures. When we look historically over the last 10, 12 years, the normal relationship between these two is about 0.25%. So right now we're at a level with PCE at 2.6. Headline inflation came in at 3 this morning for June, 3.3% in the core rate. They're still above sort of what that historical normal gap is. And so what's important to think about that, especially from the Fed's perspective, is that the CPI data is going to continue to trend lower and catch up to where the PCE number is. If you've been listening to some of the LEEP Lens Week in Review podcasts that we do every Sunday morning, you've heard us talk about this sort of difference between the two. The measurement differences, the calculation differences, the formulas, the weightings, and so on. And it's important that the Fed realizes and recognizes the difference between the two, but also understands that it's the PCE that is the important inflation indicator. So even though we got CPI out this morning that was still a 3-point-something number, the Fed really pays attention to the PCE gauge. And when they look at that, they see it coming in at 2.6% over the last 12 months. Likely when we get the June data at the end of this month, it'll show a further continued downward trend, probably down to 2.4%. So inflation is clearly moving in the direction that the Fed wants to see it. Maybe not enough to give them that greater confidence to cut interest rates at their meeting this month, but pretty likely enough evidence to give them some confidence to do so in September. The other part of the economic landscape that we look at is the labor market. And really, when we think about how the labor market has unfolded over the last several months, over the last couple of years even, there's two different surveys that come out. When we see the jobs report come out on the first Friday of every month, there's two big numbers that we pay attention to. One is the payrolls number. For June, that was 206,000. And that's represented by these orange bars here. That's where the government goes out and they ask businesses, how many jobs did he add, or how many jobs were lost by questioning, by polling businesses, establishments, and so on. The unemployment rate for June, that was 4.1%. For that number, they actually go out and they survey households. And they ask household participants, did you have a job last month? If not, were you looking for a job? Were you looking for a job in the last 4 weeks, in the last 12 months? If you have a job, but you wanted another job where there's certain factors leading to that, there's sort of this whole series of questions that they ask household participants. But that gauges then what determines the unemployment rate. And when we look at the employment number of that household data set, it tells a very different story. And that's what we see in the blue bars here. So it's the same question that's being asked of households and businesses, but sometimes we get different answers. In fact, 9 of the last 24 months, we've seen the household survey say that there have been a net loss of jobs, even though the establishment, the businesses are saying, we keep adding jobs, we keep adding jobs, we keep adding jobs, growing the economy. And so there's going to be some sort of dislocation, and the Fed is beginning to see it's not just a blip here or there, but there's a bit of some precedent for what's happening in the differences between these two surveys. And so when the Fed looks at the labor market, all of this stuff, all of these data points are relevant, but ultimately the Fed litmus test is the unemployment rate. When the Fed looks at what their expectations are going to be when they put out their summary of economic projections, they're talking about the unemployment rate. And so that becomes really important because when we look at the minutes from the June FOMC meeting, they actually spent quite a bit of time talking about this thing called the beverage curve. And that's what we've got here in this lower panel. Really, what it tells us is sort of how tight the labor market is. What we've got plotted out here is in these orange dots from 2007 through 2019, this is sort of the historical precedence of the labor market. And what we see here is that when you have a fairly high unemployment rate, you tend to have a relatively low job openings rate. If you've got a ton of available workers, you don't need to turn over every rock trying to find employees. There's plenty of people willing to get to work. Conversely, when you have a fairly low unemployment rate, you tend to have a higher job openings rate because you do have to turn over more rocks to find employees. So this orange sort of data set, this is our historical precedence for what the labor market normally looks like and should look like. The blue and the gray dots are sort of the pandemic, the COVID dislocations that we saw taking place. And then we get to March of 2022, which is also when the Fed began cutting interest rates. Began raising interest rates. And we see this very different relationship takes place between the job openings rate and the unemployment rate. And really it became very inelastic, that we had a really steep drop in the job openings rate from a 7.5% level down to a 4.5% level, but the unemployment rate has barely budged. It went from about 3.7% down to about 3.4%, and now back up to 4.1% where we are now, which is sort of at the cusp of sort of getting back into this more normal range. And so when the Fed looks at the labor market and then when they look at the employment situation, they're beginning to realize that any further softening in the labor market is probably going to show up as a higher unemployment rate, not just a drop in the job openings rate, which is what we've been blessed with for the last 2 years, 2.5 years. But any further softening is likely going to show up as an increase in that unemployment rate. And the reason that becomes important is because this thing called the Sahm Rule. And if you've never heard of the Sahm Rule, it basically is a gauge. It was developed by Claudia Sahm. She was an economist at the Fed. she basically went back and did a lot of research to sort of figure out where were the triggers between unemployment and recessions. And so what it comes down to is when you have a 3-month moving average. So it's not just 1 month's data, it's sort of looking at what the trend is. At the 3-month moving average of unemployment, if that ever exceeds the lowest point of the last 12 months by 0.5%, you're in a recession. And right now, our 3-month moving average is at 4%. The lowest point over the last 12 months, that 3-month moving average has hit, is 3.6%. So we're at this 0.4 difference between where we are currently and the lowest point of that 3-month moving average. If in the first week of August, when we get the July jobs report, if we see the unemployment rate go to 4.2%, that would sort of put us into this Sahm Rule recession. And what's important to realize about the Sahm Rule when we look at sort of this trigger, that's what sort of this red line indicates, that 0.5 level. When that gets triggered, it's a coincident indicator. You're in a recession when this Sahm Rule gets triggered. And we heard over the last few days, Fed Chair Jerome Powell was on Capitol Hill doing his semi-annual testimony. He really emphasized the fact that their dual mandate of price stability and inflation, maximum employment, unemployment rate, the litmus test, they're coming into better balance. And even his own personal perspective, his own testimony was, we're paying close attention to what's happening in the labor market, because from their perspective, this Sahm Rule holds a lot of credence and it becomes a very important metric for them to be thinking about. And so as we get into the next few months with the labor market, what the unemployment rate begins to look like, they're paying very close attention to seeing if this rule gets triggered and then what that would mean for them. There is a pretty large expectation, especially after the CPI data that we got this morning, that the Fed is really poised to cut interest rates. The CPI data this morning kind of gave them the green flag to make that cut, given, as Powell was saying, their focus on the labor market, softening in the labor market, getting close to the Sahm Rule potentially being triggered. We're really seeing an increase in activity around that. What we've got here in these two charts on the left-hand side, just looking over the last few weeks, what traders are expecting when, I should say, the traders are expecting the Fed to begin cutting interest rates. There was a decent probability that the Fed would begin cutting, in the September meeting, about a 60% chance of a cut at the beginning of July. After the data this morning, that's about an 81, almost an 82% probability. So it's no longer a question of will the Fed cut? It's a question of when is the Fed going to cut? And what the market is beginning to price in is a first cut here in September, potentially another one in December. The other big thing is that the market, traders, I should say, have really stepped up their expectations for a more aggressive rate cutting cycle next year. So given that we only have about 4 meetings left for the Fed, probably get 1 rate cut, maybe we get 2 and a second one in December. But really the market's beginning to price in about a 70% chance that by next summer, the Fed's going to be down to about a 4% Fed funds rate. The Fed's own projections, their summary of economic projections, their forecast is that they'll get there by the end of next year. So the market's beginning to anticipate they're going to start in September and they're going to move a little bit more aggressively than the Fed is projecting at this point. So that's beginning to influence what we're seeing in the fixed income markets and a little bit into what we're seeing within the equity markets as well. Okay, so that's kind of where we are with the economy, with inflation, unemployment, and the Fed sort of just sitting on ready to cut rates once they get sufficient data. When we look at kind of what's been driving the market for the last 5-6 months now, if you've been under a rock and you haven't heard about artificial intelligence and AI stocks and the AI universe, this is your wake-up call. This is looking at the performance of kind of 3-4 different parts of the market over the last couple of different time periods. The key takeaway here is that what we've labeled the NASDAQ 100, this is an index, it's a basket of the most technology-focused companies. So this is where we're going to find NVIDIA, Google, Microsoft, Apple, Amazon, Tesla, Meta, Facebook. Did I say NVIDIA? Yeah, they're in there. Um, the performance of that sort of magnificent seven group of stocks has been sensational. In the second quarter, returns were over 7%. Year to date, we're looking at returns of about 17%. Over the last 2 years, the cumulative return of that NASDAQ 100 is about 72%, just in that NASDAQ 100 universe. When we look a little bit more broadly at the S&P 500, so the blue chip bellwether of US equities, a decent second quarter, a pretty good start to the year, almost 15% year to date. Over the last 2 years, a cumulative return of almost 45%. So some very strong returns from the large caps or blue chip names. But because of how the S&P 500 is constructed, it's built based on the largest companies having the most influence on it. If we take that same universe and sort of reconstruct it so everybody's equal, you don't have Apple or Microsoft or NVIDIA skewing the scales, but everybody's on the same level. That's how we get the equal weighted S&P 500. And that performance is very different. Essentially, this is looking at what's the performance of the median stock or the average stock in the S&P 500. And what we see is that in the second quarter, negative return about down 3% in the second quarter. Year to date, up about 4%. Even over the last 2 years, only up about 20%. And then if we look even further down and look at the Russell 2000, which is a benchmark of small US companies, most of these companies we wouldn't even recognize as household names. They have a market cap of $100 million to $200 million. Again, negative in the second quarter. Year to date, only up 1%. So really there's been this really narrow leadership in the market of these mega cap, super large companies. And it's a lot of technology. So this is looking at sort of four different sector-based focuses of baskets of stocks. Technology has completely led the way year to date, 1 year, 2 years. Financials have actually done better than I think most people would have expected, mainly because of what we've seen with the Fed going on hold last summer and holding interest rates at higher levels. We've seen some of the biggest banks, the JP Morgans of the world, actually do well. Mid and smaller sized banks have struggled because their deposit costs have gone up. Loans are still a bit of a struggle, but we've seen the biggest of the big banks actually do pretty well in this environment over the last 12 months. Consumer discretionary is a sector that really it's done good overall, but Amazon and Tesla have a huge weighting in this basket. And so their relative underperformance has sort of skewed how that universe is done overall. Healthcare is a sector that certain pockets of it have done well, but as a general weighting, because it's seen as a more defensive strategy, a more defensive sector, sort of underperformed. We may be starting to see some of that change with some of the data that we're getting out now. But that I wanted to use that as a way just to kind of set up where we've been, a very concentrated, a very narrow led market by the biggest of the big companies. It's primarily those tech companies that are leading the charge. I'm going to spend just a couple minutes. I want to pivot to the fixed income market and kind of look at things a little bit differently just for a minute or two, and then look at some other ways that we're seeing things play out in the market. So when we think about interest rates and the yield curve and the shape of the yield curve, what's interesting is that historically, investors expect a higher return, a higher yield for longer maturities. If you're going to tie your money up for 10 years, you would normally expect a higher return, a higher yield than if you're only investing out 2 years. That's sort of a normal slope to the yield curve. What we've seen now for 2 years, going back to July of 22, that world it's upside down. It's inverted. Short-term yields, the 2-year treasury, for example, yields more than a 10-year treasury. And right now that difference is about a third of 1%. It was as much as about 1.2% last fall, but now we sort of normalizes. But it's interesting that we've had this inverted, this upside down world of yields of interest rates, because historically inverted yield curves have predicted about 8 of the last 6 recessions. I'm going to pause for dramatic effect and let that sink in. Normally, when we have inverted yield curves, it is a precursor to having a recession. They don't always get the timing right. But when we look historically over the last 20, 30 years, inverted yield curves have preceded recessions almost without doubt. Even COVID, we had a briefly inverted yield curve in late 2019, just ahead of the COVID recession that obviously lasted for about 2 months. So we've got this inverted yield curve that really doesn't make a lot of sense. It's having an impact on the fixed income markets. We're beginning to work our way out of that a little bit. But part of that translation is in where investors are putting their bets on inflation, and not just over the next 1 or 2 years, but over the next 5 to 7 years. This right-hand panel is sort of looking at what inflation would be in the 5 years from now. This is a really important metric for the Fed. They pay attention to where these inflation expectations are. It shapes part of the fixed income market. And really what we've seen, the takeaway is that it's a stable level, but it's a level that has shifted. Pre-COVID, it was around 2 to 2.25%. And now, as we see with those red bars, we're in a range of about 2.25 to 2.5%. So investors are expecting, Treasury market participants are expecting a slightly higher level of inflation, and that's going to have some impact within fixed income markets, likely giving us a steeper, once we get back to a normal yield curve, once the Fed begins cutting interest rates, moving those short-term yields down, a little bit of a steeper yield curve as we get out into the next few years. One area that's been sort of a conundrum within the fixed income market and really just things in general is what we've seen between mortgage rates and treasury yields. The ultimate benchmark for a 30-year fixed rate mortgage, sort of a plain vanilla mortgage, the benchmark for that is a 10-year treasury. When we look at the historical difference between those two, we typically see about a 1.5% to 2% difference between the two, meaning a 30-year fixed rate mortgage in blue here is about 1.5% to 2% higher than a 10-year treasury. Even pre-great financial crisis, this was the relationship of the 10-year treasury around 4.5%, a 30-year fixed rate mortgage at about 6%. Post GFC, with all the changes that we saw in the mortgage market and the housing market, we still had that very similar relationship of about 1.5% to 2% between the 10-year treasury and a 30-year fixed rate mortgage. Now we're in an environment that spread has widened out tremendously. We're looking at, even with a 10-year treasury at 4.5%, 30-year fixed rate mortgages well above 7%. Even with yields coming in over the last couple of weeks and even today, 30-year fixed rate mortgages are still substantially higher, 2.75, 2.8% percentage points higher than a 10-year treasury. Part of the problem with this is that the Fed is sitting on over $2 trillion of mortgage-backed securities on their balance sheet. So this will eventually begin to repair itself, compress, but it's going to take time because the Fed is sitting on a massive amount of these securities, and it's just going to take time for that to be repaired. What that creates, though, is an incentive for investors in mortgage-backed securities to pick up extra yield. This relationship will gradually dissipate. The spread will dissipate, and that will create additional return potential. But it's something that we're looking at within the fixed income market as a potential opportunity, knowing that we'll eventually get back to that more normal spread and that more normal level. So, okay, so that's kind of where we've been with the equity and the fixed income markets. I want to take a few minutes and just touch on some of the core themes of what LEEP is doing, how we're building portfolios, what our strategy is, and kind of where we look. And to take a step back and just kind of think holistically about when we're building client portfolios, at the core of each client portfolio is sort of these 4 pillars, these 4 sectors, 4 themes that we're investing around. And that's going to make up anywhere from maybe 60 to 100% of a client's portfolio, depending on the risk tolerance, their time frame, all those factors for each client. But that's the nucleus of how we're managing client funds. We'll then look for opportunities where it makes sense to use some option strategies or do some overlays to help protect client portfolios. If we were looking at a situation that we were thinking the markets could be down 7, 8, 10% over the next 2 to 3 months, there are a few things we could do to help buffer that. Certainly, we could just reduce risk and sell the risk assets, sell stocks in the portfolio, bring that level of risk down. That's one potential option. Another would be to think about, are there strategies, are there some investment methods that can help reduce the downside without necessarily giving up some of the upside? And so those are the kinds of things that we're looking at when we think that we could be in a situation where not just a 1 or 2% pullback, but a more substantial correction, 7, 8, 10% kind of pullback could be justified, that we want to kind of create some buffers around client portfolios. That's sort of what that index level option overlay does. It kind of gives us some buffer. We can use it on the upside as well. If we do see that pullback, that correction in the market, and we feel that things have been overdone and we want to have a little bit of sort of leverage to the upside, we can then use some option strategies to help reaccelerate gains back in the portfolio. And then we'll also do some opportunistic event-driven strategies. We're on the cusp of the second quarter earnings season. We had Delta and Pepsi out this morning. We've got a couple of big banks out tomorrow. And this could create some opportunities where market pricing sentiment is really negative on a particular company, and the earnings results end up being slightly better than expected. And that creates a 10 or 15% move in the stock price. With the right options strategy in place, that could result in a 200 to 300% return on the option strategy. Very opportunistic, very event-driven, very specific. Small part of the portfolio. We're not looking to take a lot of risk with that. But if we do see a mispricing unfold in the market, then we want to be able to take advantage of that where we can. So that's sort of the big picture of how we're managing portfolios. Those sort of 4 pillars, those 4 themes within sort of the core, the nucleus of the portfolio, there's really 4 sectors that we're investing around. Within technology, it really is about AI, artificial intelligence. And it's not just, do we own NVIDIA and do we have enough NVIDIA? It's thinking about the whole life cycle of what that artificial intelligence universe looks like. It's in holding companies like ASML, which creates the equipment necessary to make the semiconductors that are designed by NVIDIA, that then go on to the motherboards and the platforms that Supermicro makes, that then go into the servers that are then hosted by companies like Microsoft and Google and even Amazon with their cloud infrastructure. And then you've got application companies like ServiceNow or Palantir or Palo Alto Networks that do cybersecurity and other applications within that artificial intelligence universe. So it's not just about the semiconductor chips themselves. That's a part of it. Qualcomm also does some playing in that semiconductor chip space. But it's sort of looking across the whole life cycle of the equipment piece of it, the hardware piece of it, as well as the application side of it, the software side of it, and think about that whole collective universe. We also bleed that over into our healthcare exposure. So when we think about the ability for artificial intelligence to expedite the drug discovery process and sort of the transformational shift that will have for certain biotech, pharmaceutical companies like AbbVie and Vertex are really on the cutting edge of using artificial intelligence in their drug discovery process. And that creates some huge advantages for them to be able to bring drugs to market quicker and faster and safer even. The other component of our healthcare exposure is really thinking about metabolic disorders. Diabetes is perhaps the greatest healthcare crisis in this country. People hear about Ozempic, Wegovy, Mounjaro, Zepbound, all the GLP-1 drugs. There was some news out of Pfizer this morning trying to create a pill that will replace the same attributes of the GLP-1 shots. That's a huge focus. And whether the drug companies are thinking about obesity as a problem, we look at it from it's a metabolic disorder. Diabetes is a huge problem. And there are different ways to explore that. Yes, one is through drugs, pharmaceuticals. Novo Nordisk is one of our big holdings in that space. But it's also looking at companies that make equipment around the monitoring, some of the control, the input around diabetes management. So a company like Dexcom that makes glucose monitoring devices. they're a huge player in that space, and they really fit in well. One of the things we saw from Dexcom last summer, when there was a massive push into Eli Lilly and Novo Nordisk because everybody wanted to buy the GLP-1 drug companies, Dexcom came out and said, hey guys, people are still using our devices. We're still growing in the marketplace. And we've even seen Samsung coming out with their newest watch, which is having some increased capabilities around monitoring certain levels within the blood, within the heart rate, within the biomechanical processes that can essentially replicate what is a continuous glucose monitoring device can do as well. So there's a huge opportunity within that space of the management of metabolic disorders, diabetes, and so on, that's still being met. And a company like Dexcom does a great job in there. Consumer discretionary is another big space that we have exposure to. We actually think of Apple as being in this space. In part, yes, they do technology. Yes, most people consider them a tech company. We pay our cell phone bill religiously. We never question whether we're going to pay our cell phone bill or go to the grocery store. Most people spend an average of probably 7 or 8 hours a day on their devices. So we could even make the case that a company like Apple is more of a consumer staple because it's such a fundamental piece of how we do everyday activities. But we put it in this sort of consumer discretionary space. We then also have some exposure into some very specific parts of the consumer universe. You may have never heard of Deckers brands, but you've probably heard of Hoka running shoes. You've probably heard of Uggs and Sanooks. Those are all shoe brands under the Deckers portfolio. Own Holdings is a Swiss shoemaker, really big in the tennis world. They're also getting into the running space as well, giving Hoka and Nike a big run for their money. So very specific opportunities within the consumer space. Costco is one of our other favorite holdings. They just came out last night and announced that they were going to be raising membership prices. The first time in 7 years that they've actually raised the membership prices. And that's a good thing for Costco. It's going to help increase their revenue and give them some good additional source of funds. Walmart and Amazon certainly within that same space. So within the consumer discretionary, we look for some really kind of broad exposure names. We also have some very specific niche names, but that really gives us a good exposure into the consumer side. The last main pillar of the investment theme is very selectively within financials. I mentioned JP Morgan earlier. Bank of America is another one of those key banks that we really like and have some good exposure to. Berkshire Hathaway, if you didn't know, that's Warren over there sitting over my shoulder, always keeping an eye on things, making sure we don't get too far out of line. Berkshire Hathaway, it's such a well-run business. Capital allocation is so good. First Citizens Bank share. First Citizens Bank is where we have some select exposure, and really it's a unique bank process. They have some really interesting add-on businesses. They actually picked up a lot of Silicon Valley Bank last spring after SVB failed. They acquired CIT Lending a couple of years ago. So it's a quiet bank, but a very well-run bank. And then we also have American Express, just for a little bit of broader exposure in that financial space. So those are sort of the 4 key pillars. And these 4 sectors make up typically about 75 to 80% within that core portfolio. We really emphasize looking for great opportunities within these spaces because from a thematic standpoint, when we look at what the next 2, 3, 5 years where we believe the returns are going to come from, it's companies in this space. And that's where we want to have the exposure primarily within client portfolios. Okay, so let me kind of transition and spend a few minutes just sort of looking at some of the sort of opportunities, and I want to just touch on some technical levels real quickly. This chart may be a little bit difficult to see, but really I want to paint a picture of where I touch on what the returns have been, but I want to give a visual to what the markets look like over the last year or so. This is a chart of the S&P 500. And what we've got in these lower 2 panels are some technical indicators. The key takeaway is that in this is a relative strength index, this first one. When this gets above this blue horizontal line, which is 70, generally that's an indication that things are overbought, that there's a little too much froth, there's a little too much excitement. And what we normally see is eventually we see this trend down. So this is now at about an 80 level, and that's high. That's a fairly high reading. This lower panel, it's a stochastics measure, similar kind of output. When it gets above this horizontal blue line, generally that's telling us things are overbought, things are overdone. And we can be sort of in a setup that we see a pullback in the market, that there's a window for things to kind of mean revert back down again. So when we look at a setup like this and think about, okay, things are overbought, there's a little bit of froth in the market. If we were to see a pullback in the market, what's sort of a rational level? What would be a relevant level for the markets to come back down to? Is it a 2% correction like we saw kind of in the second half of June? We had these overbought indicators around June 15th, but really only had about a 2% correction in the market, pullback in the market. If we were to see something more substantial, what could that look like? So this white line, it's a Fibonacci retracement. Really, it is designed to give us a sense of if we did see a more substantial pullback, what kind of a level could we get back down to? For the S&P 500, that would be somewhere going from about 5,600 where it is now down to about 5,250, maybe 5,300, which would be about a 6 to 7% pullback in the market. That would be sort of a good testing ground to see kind of a little bit of that froth coming out of the market. When we look at the NASDAQ 100, very similar setup. We see really overbought levels on these technical indicators, which give us a little bit of caution like we saw last about a month ago in mid-June. Same thing, if we were to see kind of a substantial, decent pullback, we'd be down about a 7% level. So that's the kind of setup, that's the kind of technical analysis that we look at to get a sense of, are things a little bit too frothy? Are we seeing a need to do some rotation? Do we need to maybe think about putting in some of those protective overlay strategies to buffer some of the downside if we do see some of that unfold? And the reason sort of that level becomes important and substantial, when we look at the Russell 2000, it has a very different technical setup. It's not overbought. It's sort of in this middle ground of both the RSI and the stochastics. When we look at a Fibonacci retracement, it bottomed last October along with the other major indices. It actually peaked towards the end of March. And since then, it had a pullback down to about this second Fibonacci level, then retraced. And then it really kind of hit this first line, which is also around the 50-day moving average and a few other things that really helped create a bit of a foundation, a bit of a support level. So when we look at the market today, the headline is going to be the market's down. And if we're only talking about the S&P 500 and the NASDAQ, that's true. The Russell 2000 is up. Last I checked, it was up about 1.5%, almost 2% today. So we're starting to see a little bit of a transition in awareness that the super mega cap tech heavy parts of the market may be ripe for a pullback, while other sectors, small caps, for example, could be ripe for a little bit of a rotation into, and we see some upward movement in some of these other sectors and some of these other areas of the market. Okay, so thinking about that and then some of the macro events that we're sort of faced with over the next few months. First and foremost, if we think back to the beginning of June, end of May, from the Fed's perspective, there was a really good discussion, a really good argument to be made about hiking interest rates. Inflation was still elevated. Unemployment was still 3-something. The last few months have kind of changed that conversation. And now the threshold for rate hikes is substantially higher because of the softening that we've seen in the labor market. So rate cuts are coming. I think that's pretty much a unanimous perspective at this point. And it's a question of how soon, likely September, and then how many do we get in 2025? And then sort of the ultimate goal is it somewhere between 3.5% and 4% that the Fed migrates down to. The second sort of big thing is this idea of a soft landing. It's been talked about widely in the media. It's been reported on. It's been mentioned. What exactly is a soft landing? It's basically where the Fed can bring inflation down without a rapid acceleration of unemployment, triggering that Sahm Rule, which makes the Fed freak out. And then they can gradually reduce interest rates over the next 12 months, 12 to 18 months. That's sort of a soft landing. That's the base case. If we get economic data that deviates from that scenario, then we would expect there to be a market reaction. But if the data come in supportive of that sort of base case scenario, then that's going to be consistent with kind of where the market is right now. So the big elephant in the room, pardon the play on the Republicans, is obviously the election. We've had the one debate going on so far, and there's certainly a high probability that we could see President Biden no longer on the ticket. Plenty of political pundits wanting to chime in about that. We wanted to put a little bit of thought into what a Trump presidency could look like. A lot can change between now and November for sure. We've got over 100 days before the election. But likely what we would see from a Trump 2.0 presidency, higher tariffs, lower taxes, tighter border controls, potential immigrant deportation, a revision to global alliances such as NATO, sort of an isolationism with a domestic focus kind of a mindset, and increased domestic energy production, drill, baby, drill. And that would have certain monetary policy implications, fiscal policy implications, market implications. Over the next few months, we're going to begin exploring that and thinking about what that really could look like. The market's really not even focused on that yet until we get through their conventions. If we get a change in the Democratic ticket, that will have some implications. And critically important are the House and the Senate races, and potentially whether the Democratic Party writ large begins to focus more down ballot and look at supporting additional candidates if Biden insists on staying at the top of the ticket. There could be some changes to sort of what those other races look like. But again, still a few months left on that. I mentioned we're at the cusp of earnings season. Interesting takeaway here is something that we're paying close attention to. Normally during the course of a quarter, Wall Street analysts will come out and make revisions to their estimates. And normally it's moving their estimates down. They lower the bar. So when companies come out and report earnings, oh my gosh, they beat by 3%. That's amazing. Well, analysts lowered their estimates by 3% during the quarter. In the second quarter, we only saw analyst estimates come down about 0.5%. The bar has not been lowered really. So when we think about what companies are going to be reporting over the next 3-4 weeks, it's a pretty high expectation. Analysts, market participants have a pretty high bar for where they want to see those earnings. And if we don't see a huge beat by 2 or 3% earnings beat, that could set the markets up for some disappointment. Overall, we're expecting earnings to be up about 10% in the second quarter from second quarter last year. So that's a pretty lofty level. So we're going to be paying close attention to how the earnings come out and where sort of the responses are to those earnings announcements. And then finally, the market and the sector performance. So this is kind of a good day to be looking at this. Do we continue to see the Mag 7 lead the market higher, or does that become a more defensive strategy? And we see on days like this, the rest of the universe, the small caps, the equal weighted version of the S&P 500 begin to do better than just that sort of elite top tier of the S&P 500 or the NASDAQ 100. Small caps versus large caps, we see some rotation between those two, maybe even some domestic versus international. We're not biased one way or the other. Certainly we have exposure in international names. We just look for opportunities within those themes where we can find them. But the markets may take on a little bit of a focus internationally versus just domestic US equities. And then this final point here, we're in the fourth year of a presidential cycle. I'm not a big believer in cycles being the absolute guide for investing. But historically, the fourth year of a presidential cycle, where we are, is a strong year. Average returns are up about 20%. So halfway through the year, we're at about 15% for the S&P 500. Not to say we couldn't see a 5, 7, 10% pullback and then a rebound as we head into post-election 2025 time period. but that may be sort of what we see take place over the next 6 months or so, heading into the end of the year. So that's what I really wanted to kind of give some perspective on and share some thoughts around where the economy is, what we've seen in the markets, where the strategy is, still focused on those four key themes around AI, between healthcare, consumer discretionary, financials. We'll probably see some rotation as we get into the next few weeks of rebalancing a little bit within sort of that macro perspective, being mindful of sort of what some of the macro events are, some of where the technicals are stacking up. But the investment strategy is really going to be consistent with where things are now. So I'm going to pause there. And if you have any questions, I mentioned you can throw them in the chat. Looks like we've got a couple questions coming in. So feel free to ask anything that may come up. One of the questions that we've got, what is different this time in predicting when the Fed is going to cut rates? We've heard before. Yeah. So the idea that when we started 2024, the market was pricing in about 6 or 7 rate cuts by the Fed, because we had seen some softer economic data at the end of last year. And we were hoping, the market was hoping, participants were hoping that we would see some sort of pull through from the Fed in cutting interest rates this year. What's different this time is that we've seen not just the inflation data come down, but we've seen that softening in the labor market as well. At the end of last year, the Fed was really focused on inflation, and they felt like the labor market, the unemployment rate, was really in a low place, 3.6, 3.7% at the end of last year. So they really only had to be focused on just bringing inflation down. And to the extent that they felt like they'd accomplished some of that, but weren't convinced, they didn't have sort of that really good confidence around it, that sort of delayed the onset of rate cuts aggressively happening this year. Now that we've got sort of this dual mandate and better balance, yes, inflation has moved down and it's in the mid 2% level, but we're also seeing the softening in the labor market. It gives the Fed a little bit more credibility to consider cutting interest rates. We've got another question coming in about exposure to China and some non-US opportunities. Certainly there's an argument to be made that the economic landscape in China has underperformed from a relative perspective to other Southeast Asian countries, Europe, certainly the US. Coming out of the COVID pandemic, they had much tighter controls around lockdowns and other things that really quashed economic activity. What we're beginning to see now is some loosening of that activity. We're beginning to see the manufacturing reaccelerate. From just a pure opportunity standpoint, there is an argument to be made that there could be some good opportunities in China. Some of their technology companies are in that AI space as well. Alibaba, Tencent, Xiaomi, that really have some great exposure within not just the Chinese market, but other Southeast Asian and other global markets as well. The potential rub comes in, what does a Trump 2.0 presidency look like? What do the tariffs, how much higher do the tariffs get on China? Does that have spillover effects with other countries implementing similar things? And that's a tough question to answer right now. But from just sort of a fundamental perspective, there are some good opportunities in China that we're exploring, looking at, thinking about how that might fit in. Yeah. Another question about sort of the geopolitical landscape with a potential Trump presidency and what that impacts on the currency side, what that might mean for the dollar. So let me take a second to kind of just unpack this a little bit of what a Trump presidency would look like. Higher tariffs, which ultimately become a tax on the consumer, tax cuts, or at least an extension of the tax cuts that were done in his first presidency. Implicitly, those things would likely be inflationary. And so if those two combined effects of higher tariffs and lower tax stimulates more demand, economic activity, creates a higher level of inflation, that could ultimately, in 2025 or beyond, lower the chances of the Fed cutting interest rates further. And so if the Fed only gets down to a 4.5% Fed funds rate, for example, they get a couple of cuts in and then realize inflation is beginning to reaccelerate because of the fiscal policies of a Trump presidency. And they then realize, okay, we got to put a stop to this rate cutting. Raising rates would be a separate story, but first step would be just putting a floor on those rate cuts. Implicitly, that would then strengthen the dollar because the market is beginning to price in 5, 6, 7 cuts from the Fed. Part of the reason that we're seeing the Japanese yen stronger today, the euro stronger today, is on this accelerated path of interest rate cuts by the Fed, weakening our interest rates relative to Europe, to Japan, others on a relative basis, putting downward pressure on the dollar. So if a Trump presidency involves higher tariffs, an extension of tax cuts, both potentially inflationary outcomes, that would then change the Fed's perspective, stop rate cuts, potentially raise rates. That would ultimately then strengthen the dollar back up again. Could we reach parity with the euro? Potentially, if we were to see the European Central Bank, they've done one rate cut in June. They really did sort of this hawkish cut of, they did it once and they were clear that we're not going to keep down this path forever. We're going to evaluate and see where the conditions are, see where the economy is, where inflation is, and so on. And we'll reevaluate at each meeting. If the European Central Bank were to implement 3, 4 more rate cuts, then we could potentially see parity with the euro. Any other questions? Okay. Well, thank you all for your time. I hope this has been an enjoyable time for you, that you've been able to capture some good information, that I've been able to sort of enlighten some of your thinking around what we're doing within the portfolio and how we're managing investments. If you do have any questions, feel free to reach out to me. You've got my cell phone number, you've got my email address, my LinkedIn. If you're not listening to the LEEP Lens, our week in review, check us out on Spotify. It's the LEEP Lens podcast. It's about a 5, 6, 7 minute recap of what happened last week in the markets, what the big drivers were, what we think is going to be shaping the markets in the coming week, give you some of the highlights for what we're paying attention to. It's just a good way to get sort of an inside track on what our thinking is. So with that, thank you all for your time.